When the company has stable profits year after year, it can always pay higher dividends to its shareholders. What is the meaning of cash flow position? It refers to the flow of cash into the organization. In order to cater to the need of such investors, it is essential for the company to declare dividend at regular intervals. Planning is bridging of the gap between the present and the future. Hello everyone, I am Purnima, faculty in the Department of Commerce, Vidhyaashram Pre-University College, Temple of Excellence. In this session 2 on financial management, we will be dealing with the dividend decisions and the various factors affecting the dividend decisions. Now, let us just analyze what are the dividend decisions. Now, let us understand what is the meaning of dividend decision. Now, dividend is that portion of profit which is distributed to shareholders. The decision involved here is how much of the profit earned by the company is to be distributed to the shareholders and how much of it retained in the business. Now, whenever we talk of dividend, dividend is nothing but a part of the profit which has to be distributed to the shareholders. Or in other words, dividend is a return on the investment of the shareholders, or whatever share capital which is provided by the shareholders, we are giving them the returns in the form of dividend. Now, when we are paying dividend to the shareholders, the entire profit will not be paid as dividend to the shareholders. A part of the profit will be retained in the company. That part of the profit which is retained in the company is called as retained earnings, and there is a certain portion which will be distributed to the shareholders. Now, the company has to decide what portion of the profit should be set aside and what portion of the profit should be distributed among the shareholders. Now, in this dividend decision, let us see what else they have to say. While the dividend constitutes the current income, reinvestment as retained earning increases the firm's future earning capacity. The extent of retained earnings also influences the financing decision of the firm. Now, we all know that whenever the company makes profits, a part of it will be set aside as retained earnings and rest of it will be distributed among the shareholders. Now, when we know that a part of the dividend will be set aside as retained earnings and a part of it will be distributed among the shareholders, we should also understand that this retained earnings which will be with the company, that will also have future earning capacity. Now, this portion of the profit which is being retained by the company can be reinvested by the company and it can earn future profit for the shareholders. Therefore, it is necessary to know what is the retained earnings which will be in the company, because the amount of retained earnings which is present in the company will have an influence on the financing decision of the company. Now, the next part of the dividend decision, we will just look into the factors affecting the dividend decision. Now, the first factor which affects the dividend decision is the amount of earnings. The dividends are paid out of current and past earnings. So, we should understand that whenever the company earns profits, the shareholders expect a part of the share of the profits. Now, this will be paid out to the shareholders as dividend, and dividends are paid out of current and past profits of the company. So, this will have a bearing on the dividend decision. Then, the next factor affecting the dividend decision is stability earnings. Other things remaining the same, a company having stable earnings is in a better position to declare higher dividends. Now, when the company has stable profits year after year, it can always pay higher dividends to its shareholders. So, stability of earnings will have a bearing on the dividend decision of the company. Then the third one is stability of dividends. Companies generally follow a policy of stabilizing dividend per share. Dividend per share is not altered if the change in earnings is small or seen to be temporary in nature. So, if you can notice some blue chip companies or those companies which always earn profits every year, those companies will declare dividend to its shareholders every year. So, this stability of dividend refers to declaring dividends every year. They will be declaring the same percent of dividend every year for its shareholders. Now, when there is a small percentage change in the earnings, suppose in 1 year the company has lesser profits, then also the company will be in a position to pay the same amount of dividend which it has paid in the previous years, because it would had lot of profits of the previous years. So, it will not have a bearing on the dividend decision. Then, the next factor influencing dividend decision is growth opportunities. Companies having good growth opportunities retain more money out of their earnings so as to finance the required investment. So, growth opportunities. When the companies have many opportunities to grow, or when it has so many ways in which it can open its branches, it can expand its operations from one country to another. When there are opportunities, the company will always look for more retained earnings. So, it will retain a large part of its profit, and then this retained earnings will be used for expansion of the business. Then the next factor influencing the dividend decision is the cash flow position. Now, what is this cash flow position? The payment of dividend involves an outflow of cash. A company may be earning profit but may be short on cash. So, availability of enough cash in the company is necessary for declaration of dividend. Now, the cash flow position. Now, what is the meaning of cash flow position? It refers to the flow of cash into the organization. Even though there are situations sometimes when the company will be making lot of profits, but then there will be no cash available in the company. So, if there is any short in supply of cash in the company, then that company will not be in a position to pay dividends, because whenever it has to pay dividend, it will result in outflow of cash to the company. Hence, the company will look into the cash flow position in the organization and then decide about the dividend decision. Then the next factor affecting dividend decision is shareholders' preference. If the shareholders in general desire that at least a certain amount is paid as dividend, the companies are likely to declare the same. There are always some shareholders who depend upon a regular income from their investments. Now, the sixth factor affecting the dividend decision is shareholders' preference. As we all know, so all these dividend decisions will be taken in the shareholders meeting or the general body meeting of the company. And if most of the shareholders think that dividend should be paid, then it will be paid. Now, when we are paying dividend, we should also know that there are some persons who will be waiting for the declaration of dividend. There are certain persons who would have invested all their savings in this company, and they will be expecting regular returns from this company for their livelihood. So, in order to cater to the need of such investors, it is essential for the company to declare dividend at regular intervals. Then, the next factor affecting the dividend decision is the taxation policy. The choice between the payment of dividend and retaining the earnings is to some extent affected by the difference in tax treatment of dividends and capital gains. If tax dividend is higher, it is better to pay less by way of dividends. Now, the next factor which is affecting the dividend decision is whether to pay the dividend or to retain it as earnings in the company. Now, the dividend decision will be affected by the taxation policy of the government. How the government will treat the tax on dividend and how it will treat the tax on capital gains. Based on this, the dividend decision will be taken. Now, if the company feels that the government is taxing more on dividends, then it will be better to pay the shareholders in other means than through dividends. So, the company will decide that it can pay the shareholders through bonus shares or any other way rather than declaring it as dividend. Because if it declares dividend to the shareholders, then most of it will go as tax to the government. Then, the next factor affecting the dividend decision is stock market reaction. Now, the investors in general view an increase in dividend as good news and stock prices react positively to it. Similarly, a decrease in dividend may have a negative impact on the share prices in the stock market. Now, the dividend decisions will affect the stock market. How it will affect the stock market? If a company declares dividend, a higher dividend to its shareholders, it means that the company is doing well and it is in a position to pay dividend to its shareholders. As a result of which, the share prices of that company will rise. But suppose the company declares the dividend in a smaller way, that is, it will declare dividend in a reduced percentage, that is, it will declare lesser dividend than the previous years, then it will have a negative impact on the share prices in the market. Why? Because they feel that the company has made a loss, as a result of which they are declaring lesser dividends to the shareholders. So, this negative feeling of the company's affairs may bring down the share prices of such a company. Then, the next factor which affects the dividend decision is access to capital market. Now, large and reputed companies generally have easy access to the capital market and therefore may depend less on retained earnings to finance their growth. Now, we all know that large companies have easy access to the capital market. So, whenever they are in need of funds, they can always approach the capital market and raise the funds which are necessary for their growth of the business. But then for smaller companies who do not have access to the capital market, they have to rely on the retained earnings. So whatever earnings they have reserved in their company, those earnings they will have to make use for their expansion plans. So this aspect will have a bearing on the dividend decisions of the company. The next one is legal constraints. Certain provisions of the Companies Act place restrictions on payouts as dividend. Now, when the company is a new company or if there are any legal constraint imposed to the company under the Companies Act, then the company is bound by such restrictions. The company cannot just pay dividends in violation of such restrictions. So, they have to keep up with the legal constraints. So, they have to see that their dividend decision does not violate the legal constraints offered by the Companies Act. Then, the next factor and the last factor affecting the dividend decision is the contractual constraints. Now, what do we mean by contractual constraints? So, while granting loans to a company, sometimes the lender may impose certain restrictions on the payment of dividends in future. So when the company is borrowing from an external source, the person who is lending the money to the company, he may impose a restriction on payments of dividend. So he may say that the dividend should not be declared for a certain number of years. So if there is any such loan agreement between the company and the creditor, then the company cannot declare dividend in such cases. Now, the next concept which we will discuss here is financial planning. Now, what is the meaning of financial planning? So, financial planning is essentially the preparation of a financial blueprint of an organization's future operations. The objective of financial planning is to ensure that enough funds are available at right time. Now, we all know the meaning of the word planning. What is planning? Planning is bridging of the gap between the present and the future, or you decide today what you do or what you want to do in future. Now, let us correlate it to the word financial planning. Now, financial planning is essentially a preparation of the financial blueprint of an organization's future operations. So, how the organization will function in the next year, what are the resources available, and how you allocate the resources to each of the activities. So, all this we will be studying in financial planning. Now, through this help of financial planning, we will ensure that there are enough funds in the company and at the right time. So, their company should not have any shortage of funds at any point of time. Next, the financial management aims at choosing the best investment and financing alternatives by focusing on their costs and benefits. Now, financial planning means you are having a blueprint for the future. Now, financial management aims at choosing the best investment and financing alternatives. That is, you should first choose what is the best investment and then the best alternative for that by focusing on the costs and benefits. Now, first you have to calculate what is the cost of the finance you are procuring, and then later on you have to also calculate what is the benefit from such investment. Only if the benefits exceed the cost, only then we can go ahead with such plans. Then, financial planning, on the other hand, aims at smooth operations by focusing on fund requirements and the availability in the light of financial decisions. Now, we should ensure that the company is always having proper finance. So, whenever there is a plan for expansion, there should not be any shortage of finance in the organization. This we can achieve through proper financial planning. So, when you plan for the company, you always forecast something. So, what is this forecasting? So, you forecast that the company will set up a branch in such and such a place. Then, when there is a proposal to set up a new branch, then what are the requirements? What are the financial requirements of setting up a new branch, and how do you procure? All this will have to be pre-planned, and everything, all the resources have to be adjusted so that the company can go ahead with this plans. So, all this will be possible only through proper financial planning. Then, next, financial planning process tries to forecast all the items which are likely to undergo changes. Then, it enables the management to foresee the funds requirement, both the quantum as well as the timing. Now, In the financial planning process, it will forecast all items which are likely to undergo the changes. Now, what is this forecasting? Forecasting is a part of planning. So, through forecasting, we can foresee what are the changes which will be there in the environment. So, the business environment keeps on changing. It is dynamic, and based on the changing environment, we also have to see the changes in the atmosphere of the business. So, we have to foresee what will be the financial requirements of the business in the changed circumstances, and as such, we have to be prepared for that changes. We have to see that the proper financial allocation is done and proper finances are procured at the right quantity and at the right time. Then, next, financial planning strives to achieve the following twin objectives. Now, what are the objectives of financial planning? First one is to ensure availability of funds whenever required. So, this includes proper estimation of the funds required for different purposes, such as for purchase of long-term assets or to meet day-to-day expenses of the business. Now, whenever we have financial planning, it will be on the basis of two objectives. Now, the first objective is to ensure availability of funds whenever required. Now, how do we do this? It is through proper estimation of the funds required for different purposes. So, when the company wants to invest in a fixed asset, it wants to buy machinery, it wants to buy a land and building. So, if there is a major investment proposal in front of the company, then it has to see that this proposal goes through. How it goes through? With the help of proper financial planning. And it also has to see that when we make any major investment in the company, it will not affect the day-to-day expenses of the company. So, the company needs both fixed capital and working capital to run the organization. So, the fixed capital is necessary to purchase fixed assets of the company, whereas the working capital is necessary to meet the day-to-day expenses of the company. So, both are essential for the company, and a balance between these both will help in efficient running of the organization. Now, the second objective of financial planning is to see that the firm does not raise resources unnecessarily. Now, excess funding is almost as bad as inadequate funding. Now, the second objective is to see that the company does not unnecessarily raise funds. Now, what will happen if there is excess funding in the organization? It may lead to embezzlement and theft of cash. So, whatever cash is available in the company, it should be put to the best use and see that there are almost returns for every investment in the company. The company should ensure that all the resources are properly utilized. Then, the financial planning takes into consideration the growth, performance, investments, and requirements of funds for a given period. It includes both short-term as well as long-term planning. Now, with the help of financial planning, whenever we are making financial plans, we will be taking into consideration the growth of the company, the performance of the company, the investments made by the company, and requirement of the company for a given period. So, the given period may be usually 3 to 5 years. Now, the financial planning includes both short-term as well as long-term planning. So, we should understand that financial planning goes a long way in ensuring that proper funds are available in the company and at the right time. Next, we'll just discuss about the importance of financial planning. Now, it helps in forecasting what may happen in future under different business situations. Now, why we consider financial planning as important? Because it helps in forecasting in future what may happen under different business situations. Now, through this, we can understand the financial requirements of the business. Then, second importance is it helps in avoiding business shocks and surprises and helps the company in preparing for the future. Now, whenever we are making a plan for the future, we will have to anticipate any of the setbacks. So, what may be the setbacks which we may come across in future? So this we will be just thinking of, and then we will be making our plans, and then when we actually get a setback in our plans, we will be well prepared to meet such contingencies. So financial planning helps us to meet with contingencies in a proper and effective manner. Then the third importance of financial planning is it helps in coordinating various business functions. Example, sales and production functions by providing clear policies and procedures. Now, how it will help in coordination between various departments? Suppose we are to have a plan today. So, if you have to have a financial plan, the first thing we will do is we have to make the sales plan. What is the planning for sales, or what is the forecast for the sales in the next year? Then, depending on the sales forecast, we have to see that there is proper production facilities also in the company. And if the production can meet the sales target, then it is fine. But then if the production does not meet the sales target, then we have to ensure that proper production facilities are provided so that it can ensure the proper sales target, and hence because the production are to be increased, we will need more finance. So all these considerations or all these decisions involve financial planning. Then the next importance of financial planning is detailed plans of action prepared under financial planning reduce waste, duplication of efforts and gaps in planning. Detailed plans means for every minute thing you have a plan. So when we take care of all the smaller things in the financial plan, it will reduce the wastages in the organization, and also it will reduce overlapping of efforts or duplication of efforts, and also the gaps in planning. So we should ensure that there are no gaps in planning. Then the next importance of financial planning is it tries to link the present with the future. So we all know that planning is bridging the gap between the present and the future, and so we can also safely assume that financial plan is a link between the present and the future. Then the next importance of financial planning is it provides a link between investment and financing decisions on a continuous basis. Now, it provides a link between investment and financing decisions. So, we all know that investment and financing decisions are always interlinked. So, whenever you have to make an investment, so you have to procure finances for that investment. So, in order to procure finance for that investment, we have to look in for cheaper sources of finance. So, once we just identify the cheapest source of finance, then we also have to calculate what is the return we are getting on our investment. So, based on all these considerations, we have to make our financial plans. So, we consider it as important, and it should be done regularly on a continuous basis. Now, by spelling out detailed objectives of various business segments, it makes the evaluation of actual performance easier. Now, whenever we are making financial plans, it will see that there are detailed objectives of each segment. So, at each stage of the plan, you have the objective, you have the resources needed, you have the time frame. So in this way, if we can have a detailed plan of all the activities in the organization, it makes evaluation of actual performance easier. So you have already set standards for each level of activity, and when the actual performance meets those standards, we can easily evaluate the response of the activity, or we can easily evaluate how the company is doing through this comparison between the actual and the standard. So this will help in easy evaluation of the activities. In this session, I have discussed about what are the financial plans which can be made, the importance of financial plans, and also all those factors which influence the financial planning of an organization. Hope you have all understood the session on financial management. Thank you.